Berkshire Hathaway revealing a sizable stake in United Healthcare.
Shares United Health getting a so-called Buffett bump today after Berkshire Hathaway and a number of other big-name investors reveal new positions in the insurance giant.
United Healthcare shares have been on a tear lately, gaining around 50% from its lows, showing short-term optimism despite the stock currently trading in historically low valuations. So why is UNH trading in these lower ranges? And why did I see this as an amazing buying opportunity even before Buffett's announcement? Let's find out. But before anything else, to those who are new here and would like to support this type of content, please like, comment, and subscribe so I can create better content for all investors out there. So now, let's do a quick recap of the events that have impacted the company's stock price and public perception. UNH was suddenly under public scrutiny following the events that led to the death of their insurance arm CEO, Brian Thompson. Additionally, fraud allegations started to circulate as the Wall Street Journal reports that the DOJ is now investigating the company. Just 2 months after this, the company slashed its guidance due to the higher than expected medical care costs, which started their steep decline in the coming months. This led to the resignation of their current CEO at that time, Andrew Whitty, and was replaced by Stephen Hemsley, with the WSJ continuing to report fraud allegations and continue to recycle the news. Despite all this noise, an active investor's role is to look past it and see whether or not the current and future earning power of the company is still intact while trading below intrinsic value. And that is exactly what I did. First, I wanted to understand the valid scrutiny that the company has received. By valid scrutiny, I am pertaining to 1. UNH slashing guidance, 2. Their CEO resigning, and 3. The fraud allegations that they have received, as these are the factors that may affect the company's earning power moving forward. So, reason 1. United Healthcare guided lower due to medical care costs increasing at an unexpected rate. But what caused this? UNH cited that they observed increase in care patterns that are above their estimates, paired with increases in healthcare unit costs and intensity of services delivered. In short, cost trends are above current estimates. There is no direct answer for why the trend moves this way, but people assume that the cause is the potential changes in the government spending for the healthcare industry, such as the Big Beautiful Bill Act, which may have led people to take advantage of their benefits before any major changes may occur. This caused the medical care ratio of the industry to be higher than normal, but I think that this is easily addressable, as health insurers are required to submit rate adjustments every year, which justifies higher premiums due to rising medical costs. As an example, the median proposed hike in premiums is about 18%, or an 11% increase from last year. Next, let's talk about reason 2, the resignation of Andrew Whitty and why Stephen Hemsley stepped up to the plate. As an outsider looking in, I was initially terrified with CEO changes, as this may bring more turbulence to the company's fundamentals. But the new CEO dispelled this bias of mine due to his amazing health insurance background. He joined the company in 1997, and 9 years later, he was leading the company as the CEO. He held this position for 11 years, basically overseeing the massive growth of the company before becoming the executive chairman of the board. As the company now faces multiple headwinds, he has decided to take the helm and lead the company back to historical growth prospects. To show top management's confidence, massive insider buying activity happened when the company reached prices near or below $300. Notably, Stephen bought $25 million worth of shares at an average price of $288.57, with his own money. Additionally, he sandbagged their second quarter 2025 earnings, basically estimating a measly $16 per share of adjusted earnings. To put that in perspective, the company currently has $10.61 per share of diluted earnings, with the year only being half done. Additionally, the company has gained more than $16 per share of adjusted earnings per year since 2020. This shows his experience and expertise in understanding and controlling Wall Street sentiment. And lastly, reason 3, Wall Street Journal's fraud allegations. This remains unclear as to where this may lead. At best, I understand that this is a virus that the largest companies in all industries face: regulatory scrutiny. Major tech companies such as Google and Microsoft, payment oligopolies like Visa and MasterCard, are always in hot water due to the expensive businesses that they have. As UNH is the largest health insurer in the world, I am not surprised that they are experiencing this, especially after all the events that have transpired. Now that we are all up to date with the company, the next question is, why didn't this negative press prevent amazing capital allocators from purchasing the stock? Now, let's dive into the company's competitive advantages, or as some people call, their moat. Their first and most obvious advantage is size. In terms of the industry's trailing 12 months revenues, UNH posted a whopping 22.20% market share. The only company that comes close to this is CVS at 19.99%. This size comes from their ecosystem of companies, which creates economies of scale and network effects for them. Starting with their ecosystem, they basically run two main subsidiaries: their insurance arm, United Healthcare, and their services arm, Optum. These two units work hand in hand in creating an efficient business model that creates operating leverage for their group. This leverage is evident when compared to peers, which I will cover in the latter portion of this video. Aside from operating leverage, they also create economies of scale. As more customers use their insurance, more people use the services of Optum, and vice versa. This creates an amazing flywheel for them that also enhances their network effects. Their network effects come from the amount of demand they have, which is why they have the broad supply of medical professionals that are affiliated with the company. As for the competitive advantage that all health insurers have versus other insurance companies, they have innate pricing power due to the rate adjustments that they justify based on estimated future medical costs. This means that as long as management can properly estimate future costs on a regular basis, they can operate profitably. Now that we have a better understanding on what makes the company competitive, let's dive into the numbers that prove these advantages. To best examine the company, I will show a relative analysis among top peers in the industry. In this analysis, I will be focusing on the medical cost ratio, operating ratio, return on tangible assets, return on equity, adjusted price to earnings ratio, and adjusted price to free cash flow ratio. As you can see, UNH is operating at a different level of efficiency while having the largest market share among competitors. Boasting the lowest medical cost ratio at 85.5% last year, with the nearest competitor being only 3% higher, shows the efficiency and leverage that their ecosystem and management has created. This translates to their operating ratio being way higher than competitors at 8.1%, with the nearest only being 4.51%. To push this point further, their tangible assets and equity is even returning almost twice the amount in terms of earnings. Despite all of these advantages, the company trades at an adjusted PE of 13.12 times and an adjusted price to free cash flow of 15.70 times. This means that they have the third lowest valuation, which shows that Mr. Market is perceiving the company worse than some of its peers. Additionally, UNH's historical PE ratio is 22.15, showing about a 40% discount at current valuations. After completing my analysis with the DCF, I was convinced that there is an amazing buying opportunity to purchase the largest health insurer in the world, and so I did. I purchased the company on multiple dates and basically ended with a cost basis of $293.88 per share, as seen on the screen. As for my plans moving forward, I'll be using opportunity cost as my metric to buy, sell, or hold the stock. With that, I would like to end this analysis with a quote from Warren Buffett's best friend and partner, Charlie Munger. All intelligent people should think primarily in terms of opportunity cost. When deciding whether to do something, compare it with the best opportunity you have. Thank you so much for listening to my analysis. For those who are curious about my portfolio updates and changes, please don't forget to like, comment, and subscribe. I will be doing this for future videos as well. Thank you so much.